Hey guys, what's up? I'm Erin and welcome back to the channel. How many times have you heard that the safe rate of withdrawal on an investment portfolio is 4%? It's so entrenched in our investment culture that it's actually dubbed the rule of 4%. The rule of 4% says that a retiree can withdraw 4% of their investment portfolio each year without running out of money, assuming they have moderate investments and a 30-year retirement. So if you have $1 million portfolio, following the rule of 4%, you would be able to withdraw $40,000 a year. The rule also does allow you to increase your withdrawal each year, factoring in inflation. Now, when we talk about moderate investments, it means you have a portfolio that doesn't swing to either extreme. Like you wouldn't have 100% stocks or say 100% bonds. Yes, those would be considered extreme. And portfolios like those tend to have higher failure rates, and failure meaning you run out of money in retirement. But if we go back a little bit and look at the history of the rule of 4%, and who better to discuss the history than the founder of the rule of 4% himself, William Bengen. Funny enough, the rule of 4% was never intended to be a rule. It actually came about in the 90s when William Bengen himself, a financial advisor, found fault with what general rules of thumb of the times currently were. And there were generally two accepted ones. One was that the stock market was entirely too risky for retirees, and retirees should be in something like 100% bonds. That way they would know that their portfolio was stable over time. Other groups of people said that retirees were fine to stay invested and that they could withdraw anywhere from 6 to 7% of their portfolio and reasonably expect that the market would perform higher than that on a regular basis. As you can imagine, either of these rules of thumb might not serve retirees too well. If you go too conservative, you have the very real risk that you might run out of money in retirement. But if you go too risky and withdraw too aggressively from your portfolio, you run into the same problem. And you might be wondering, why would they suggest such aggressive withdrawal rates? Well, back in the late 80s and in the early 90s, the market was going through an incredible boom. And investors got used to seeing double-digit returns year after year. So suggesting a withdrawal of 6 or 7% didn't seem unrealistic in a market environment like that. Bengen recognized this problem and set out to create a better answer, and through his calculations came up with a number in the ballpark of 4%. 4% was never intended to be taken as gospel. In fact, he never called it the rule of 4%. That was kind of a marketing accident.
Yeah, and I don't think I ever used the term 4% rule. I don't believe so. That was kind of a creation of the media. When I got into interviews with the media, they wanted something simple, I understand, to present to their readers.
Right.
And they focused on that and said, this is the answer, like a tic-tac-toe game, put the X here. But, I thought about it for a while and I said, what the heck? At least there's information getting out there, which is more accurate than the information that was out there before. And I can always clarify things if they have questions.
And if you dive a little deeper, Bengen himself will be the first to admit that he doesn't strictly stick to the rule of 4%. He was a financial advisor, and with his clients, he would tend to use rates of withdrawal in the ballpark of 3% all the way up to 5.5%, depending on the client's personal situation.
So I came out with a number, and unfortunately that number has haunted me for years since then, because that one number cannot represent the experience of so many different retirees. There's just too many dimensions to the problem to have a one number solution.
Funny enough, when Bengen first came out with the rule of 4%, he received a lot of pushback in the financial community. A lot of advisors were saying 4% was way too conservative. A standard rate of withdrawal should be much higher than that. And Bengen said 4% is designed to be conservative. It's not designed to be something that sustains in an average market. It's designed to sustain the worst of the worst market conditions, based on historical data. Like if you had retired right before the start of the Great Depression and utilized the rule of 4%, not only would your portfolio still be standing 30 years later, but it would still be providing you your reliable income 30 years later. And funny enough, you still hear that the rule of 4% gets a lot of pushback. But rather than people saying that it's too conservative, nowadays a lot of people are saying it might be too aggressive. And the idea that the rule of 4% might be too aggressive really came about after Monte Carlo simulations became popularized. Because Monte Carlo simulations don't just look at whatever historically happened in the market, but they also run hundreds of other hypothetical best and worst case scenarios. For instance, a Monte Carlo simulation will run the example where the market drops 25% this year, and then drops another 25% next year, and then another 25% the year after that. We've never had a situation where that's happened, but a Monte Carlo simulation will run that example. And it is out of these Monte Carlo simulations that you often get the figure of 3% as a safer withdrawal rate. And while that situation has never happened, could it happen? Maybe. We all know as investors that past market performance is not predictive of future market performance. You also have to think that as an investor, if the market were to take such a steep decline, there's got to be a point where valuations would start to look attractive and investors would start hopping back in, saying, things are on sale, I better get in now. And if the market truly does just bottom out and completely implode, we all have bigger problems than just our portfolios because the market is reflective of our economy as a whole. And when it comes to utilizing this rule, the founder himself doesn't even strictly stick to the rule of 4%. In fact, you'll often hear him refer to it as the rule of 4.5%. And in practice, with his clients at his firm, he would use numbers ranging from 3 to 5.5%.
So I'm struck as well now. You have mentioned a few times here, you have called it the 4.5% rule. So when did you move from 4 to 4.15 to 4.5%?
Remember, originally I was just working with two asset classes. And then in 2005, when I was working on my book, I introduced small cap stocks, U.S. small cap stocks, which really juiced everything. The returns, they didn't have a perfect correlation with large cap. So that juiced it from 4.15% to almost 4.5%.
The two major factors when it comes to considering this rule are market return and inflation.
People have to keep in mind inflation is equally important as returns in this analysis, and that when you have a low inflation environment, your withdrawals are also going up much more slowly. So there's an offset to the lower returns that you can't ignore.
And when inflation is running red hot like we just saw in recent years, the author suggests that you should actually adjust down your withdrawal rate and be closer to that 3% range. You might have actually seen headlines in the past couple of years saying that the rule of 4% no longer applies, and that was largely because inflation was running so high. And in fact, Bengen himself was one of those people suggesting that you should be more conservative with your withdrawals at that time. Just as when inflation is running low, he often suggests that a higher rate of withdrawal might be more applicable, as he stated back in an interview done in 2020.
Yeah, I think people have to realize that when they use the 4.5% rule, as you mentioned, it's a worst case scenario. You know, based on what I know now, in a very low inflation environment like we have now, if we had modest stocks, I wouldn't be recommending 4.5. I'd probably be recommending 5.25, 5.5, something like that, which is even going to enrage people even more because it's higher than the 4.5%. But that's what history has demonstrated.
What's really important to keep in mind is that the rule of 4%, if you want to call it a rule, maybe you prefer to call it a guidepost rather than a rule, a little less strict. The rule of 4% is designed to be conservative in nature.
Well, 96% or more. Well, people end up with more than they started with on a nominal basis.
Right. Yeah, I think that's something that people miss a lot. Like if you look at those historical scenarios at a 4% rule, 96% of the time, your whole nest egg's still left over at the end.
That's right.
96% of people who follow this rule end up with more money than they started retirement with. 96%. That is not a drawdown method, that is a make it last method. Also, on the subject of withdrawal rates, in a recent video, I was talking about the various nest eggs you would need depending on the withdrawal rate you chose to use, whether you went with a 3%, a 4%, or a 5%. And I actually ended up receiving a bunch of questions about this segment of the video. People asking why they would need a higher nest egg if they're using a lesser rate of withdrawal. And this is actually a really great question and deserves a genuine answer. This is really how the rule of 4% is designed. You want to choose a withdrawal rate that allows you to pull out enough of an income that you can meet your life needs, but you want to choose a number that is conservative enough that your portfolio will be able to last no matter what is happening in the market or in the economy. Those two biggest factors being market performance and economic inflation. Now, inherently, the more aggressive the withdrawal rate you choose, the more risk you introduce to your portfolio. That risk being that you run out of money before you run out of time. Not a good problem to have. When you would choose a more conservative withdrawal rate, you introduce less risk into your portfolio. And probably what matters most to you when you start living on your investments is that you're withdrawing enough from your portfolio that you are meeting your income needs. Let's say you have an income need of $45,000 a year to come from your investments. If you need $45,000 a year from your investments, the portfolio you would need to meet this requirement depends on the rate of withdrawal you believe in using. If you want to use a conservative 3% rate of withdrawal, you would need a portfolio of $1.5 million to meet this need. If you want to use that traditional 4% rate of withdrawal, you would need $1.125 million. And if you believe in a more aggressive 5% rate of withdrawal, you would need a portfolio of just $900,000. Whereas if you have a $900,000 portfolio and you use a 3% rate of withdrawal, that's really only going to give you about $27,000 a year. That's a pretty big gap if your income need is $45,000 a year. The target is what your income needs are. Remember, your goal is to meet your income needs from your portfolio, and the withdrawal rate you believe is best to use is going to determine what size of portfolio you are going to need. And there's an inverse relationship. The higher the withdrawal rate you use, the lower portfolio size you would need to meet your income needs, and vice versa. Now, I'm not trying to say that a 3% rate of withdrawal is better than a 4% or a 5%, or that a 5% is better than a 3 or a 4%. They're probably all amazing, but in different situations. It's really going to depend on what you're comfortable with and what your circumstances are. But if you tend to err on the more conservative side and want to use a more conservative rate of withdrawal, you're going to need a more robust portfolio. And quite honestly, one specific percentage is not realistic or best. For planning purposes, you might use one specific percentage, maybe 4%, but once you reach retirement, it's very unlikely that you'll stick to one specific percentage. Quite simply, your expenses are not going to be exactly the same every single year. Maybe one year you take an extra vacation, or maybe you have a major repair on your home. Then maybe you have some years here and there that are incredibly low-key. And for many people, their spending is actually higher in their initial years of retirement, lower in their mid-retirement years, and then starts to tick upwards towards those later retirement years. This is known as the retirement smile. Once you're in retirement, you're likely to find that a more variable rate of withdrawal is going to be more fitting. You'll have years where you withdraw a little bit more, maybe that 5%, or dare I say even 6%. And then you might have years where you find you don't really need much from your investments, and you'll withdraw, say, 2% or 3%. How much you withdraw is going to be influenced by your lifestyle needs for that current year, but also maybe somewhat in reaction to how the market is performing. Is it an up year or is it a down year? How inflation is going. Is it a high inflation year or is inflation running lower? As a matter of fact, utilizing a variable withdrawal strategy over your retirement has been shown to boost portfolio success rates. So what are your thoughts? Are you strictly sticking to the rule of 4% when it comes to planning purposes, or do you use a different percentage? Or are you in retirement? Do you stick to the rule of 4%? Share your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.